Hello, everyone. It's a great pleasure to be with you today. My name is Alex Arujo. I am the fund manager for M&G's Global Listed Infrastructure Fund. I join you from London, where I live and where I spend most of my time these days in the midst of the changing world that we find ourselves in. And in regards to that, the topic for today is that changing world and an increasingly required sustainable world. We'll be speaking about sustainability and ESG considerations when investing in the infrastructure asset class. Now, ESG is a wide-ranging approach to asset management and has a spectrum of potential approaches, from the very simple norms-based exclusions, which you see on the far left of this slide, all the way out to the very far right, where investing requires a positive impact. Where this approach, where this strategy sits within that spectrum is under sustainability, where sustainability-minded and sustainability-themed investing is the underlying practice. And although there is positive impact associated with this investment approach, it is not necessarily a requirement or a measurable approach as it would be in pure impact investing, which is a whole other approach to ESG. Now, when we talk about ESG, we talk about sustainable investments, most people think about the things that you own. What do you invest in? And that is, of course, a very, very important set of considerations. But equally important is an assessment of ESG risk that helps avoid situations that could become very difficult from a sustainability point of view. And an example that I like to use dates back many years, in fact, to some work that we did in the utilities sector, particularly in California, where we examined the potential for investing in certain utilities in that state. Now, California is a very interesting place. I hope some of you have had the pleasure to visit this beautiful place. But things are changing in California. California, of course, is on the west coast of the United States. It enjoys a warm, temperate climate. But what's been very interesting to monitor is the change in weather and climate patterns in California, not just over the decades, but over the centuries. So if we go back to the period straddling the turn of the 20th century, the late 1800s, up until just before World War I, in the early 1900s, we had an environment that had a typical and normal amount of rainfall and average air temperature. So what we see in this slide along the bottom is the average precipitation, and on the vertical axis, the average air temperature. So during that period, things were relatively normal, but if we fast forward up to the next roughly 100 years, we start to see that the air temperature starts to become warmer and that we have less and less precipitation. So hotter and drier summers. And then we get to the point more recently that turns the 21st century, and we see that conditions have become very dry and very hot on average. And this is inextricably, in my mind and many people's minds, linked to climate change, changing weather patterns, and we're all very aware of the potential impacts. But one of the most devastating outcomes of such a trend is, of course, forest fires. And if you've been watching the news in this part of the world and others, by the way, you will know that forest fires have started to become an annual feature, sometimes more than once a year in California, with devastating outcomes. Now, While we pause on this slide and take in the devastation, I'll tell you the story about a company that I believe became, a couple of years ago, the world's first large-scale corporate victim of climate change. It's a company called PG&E, sometimes better known as Pacific Gas and Electric, and it's a company that provides utility services to the northern part of California. Now, when the forest fires took hold, this company was initially, of course, heavily impacted because of the damage to its assets. But subsequently, we learned that the company had potentially played a part in the instigation of these forest fires through poor practices in managing their electricity transmission assets. We had identified concerns around the company's operating practices and the history of the company's asset management, and we were able to avoid investing in this company as a result of our sustainability analysis. And subsequently, what we learned, and this is a share price chart, was that the California wildfires not only damaged the assets, but damaged the company's financial position because of the potential for liabilities that it would have to pay out. So in a very short period of time, we saw significant equity value destruction. We saw the company forced to eliminate their dividend. The following year, we had another set of fires, again with the company implicated and potentially liable. And finally, in late 2018, the company was forced to declare bankruptcy. So we have a circumstance here where the avoidance of investing in a company as a result of a sustainability, ESG-oriented analysis allowed us to prevent significant capital destruction in the strategy. Now, when we talk about infrastructure, I think there's a good news and a bad news story. But I'll start with the bad news story. And that is simply that our use of infrastructure as societies around the world, typically and most importantly from the point of view of electricity generation, accounts for roughly half of the greenhouse gas emissions on the planet. So when we invest in infrastructure, we have to be incredibly selective in the kinds of businesses that we own. Make sure that these companies do not face stranded asset risk, that they don't lose their social license to operate, that they are managing their businesses and their assets with a view to supporting the energy transition. And that's why it's so important to take an active approach to investing in infrastructure. Most of the greenhouse gas emissions on planet Earth come from the generation of electricity by utilities, but then, of course, our activities in moving ourselves and goods around the world in the transportation sector account for a significant share as well. But the good news in all of this, and this is very important, is that the energy transition and the solution to climate change is very much built around the infrastructure sector, again, primarily in the utility sector, which makes up a significant share of the exposure in this strategy. The utility sector, of course, has made huge strides in innovation. It is the single biggest investor in renewable solutions. And this is where we have our focus. And it's not just generation of power, it's also the electrification of transportation, electricity storage, and a number of the companies that we hold in the portfolio are making significant investments with very good return opportunities in the energy transition. But one has to be very careful because the traditional approach of investors is to simply buy or invest in the clean energy stories because they resonate, they're uncontroversial, they are clean, they are uncomplicated. But the problem is if everybody goes in the same direction and simply invests in clean energy businesses, the purest of the pure, trades can get crowded. And what we saw over the past year and a half, was that start to unravel. Valuations became quite extended in clean energy, renewable businesses, and that was a result of money flows going into sustainability-oriented funds. And of course, that started to unwind, and there's been quite significant capital destruction in ensuing months. We've managed to largely avoid that, and the main reason is because we invest mainly in transition businesses, companies that are transitioning their own energy mix from more carbon-intensive sources to renewable and sustainable sources, arguably making a bigger contribution because they are contributing to both sides, the renewables, while at the same time decommissioning coal-fired power, for example. We do have some pure renewable exposure in the strategy, but the main focus for us is actually in the energy transition. These are more complicated businesses to analyze. They are a little bit more controversial for typical investors. They require a lot of work and engagement being the very important point that I will spend some time talking about. And I do, while we sit here, especially for our Asian audiences, want to highlight the critical importance of natural gas as a transition fuel, because the decommissioning of coal-fired power in particular cannot be replaced immediately with renewables, and to use natural gas as an intermediate fuel is a way of significantly decarbonizing electricity generation, particularly in developing markets around the world. But I would like to focus on one particular story, which is a huge success story for us, which is a company called AES. It's a US-listed electricity generation company that we've been invested in for a couple of years now, focused around the energy transition. It's a company that had some significant legacy carbon-intensive electricity generation over the years, and we took the decision to engage with that company on a long-term basis to usher in its own energy transition as a business. And here we walk through the timeline of that engagement, with our first contact with the company dating back 5 years to 2017, when the company was uninvestable with a significant exposure to coal-fired power. We met with management on a couple of occasions, stressed the importance of them decarbonizing their energy mix. And in 2020, we were happy to make an investment in the company on the back of some significant progress that they had made with regards to decarbonization. And that progress accelerated with the decommissioning or the divestment of coal-fired or carbon-intensive electricity generating assets, replaced with renewable energy assets. And so the story continued to improve. The final step was for the company to agree with one of its regional regulators a path or a solution to decommissioning the remaining coal-fired power exposure in the asset base. And just last week, the company was very happy, and we were very happy to see announced a complete coal phase-out plan by 2025, which was in fact even earlier than we had expected. And I think this is a great example of how engagement, support, and ongoing monitoring of progress can ultimately result in a big success story. And we certainly would point to this case study as being exactly that. We do need to continue to be vigilant on carbon intensity in the generation sector, in the utility sector. And the main reason is because companies with a high carbon intensity can be very likely to lose their social license to operate. It's as simple as that. And we're very pleased in our own global listed infrastructure strategy to be able to show carbon intensity, carbon emissions significantly lower than an appropriate comparator, for example, a global infrastructure index such as the FTSE 50/50 index. You can see that the exposure, the carbon intensity, the emissions are significantly less than that benchmark. And that's very, very important for us to monitor over time and be aware of. And also the path, the direction of travel. It's not enough to just be less. The carbon intensity, the carbon emissions need to be on a declining path in order to support a global energy transition. So I've spoken a lot about the utility sector. I've spoken a lot about carbon intensity and the energy transition, but that's just one part of the global listed infrastructure opportunity set. Renewable energy is expressed in a number of different holdings within the portfolio, but equally, and relatedly to the energy transition, we have some prominent exposure to an electrification of transportation. We have, from a circular economy point of view, exposure to opportunities in an increasingly urbanizing population, particularly in developing markets. We have within the strategy a dedicated exposure to digital infrastructure with a view to ensuring universal connectivity as the world requires more and more data and bandwidth and capacity to undertake its digital activities. The circular economy, as I mentioned earlier, includes water and waste management, which is another area of long-term opportunity for the strategy. And of course, as we're all very well aware, most recently, the importance and critical nature of healthcare infrastructure has become clearly apparent as an element of exposure in the fund through our social infrastructure allocation. And finally, social and demographic shifts that are affecting the world over the very long term have infrastructure opportunities associated with them. It's a global opportunity set. People tend to focus on the US and the infrastructure plan, or Europe and the recovery plan, but this is a global phenomenon. It includes China and the significant headway that China is making on the energy transition, particularly with the deployment of renewables. And we're very, very excited for this asset class over the very long term, linked to these various structural thematic drivers. So with that, I will thank you for your attention, and I will wish you well. It's been a great pleasure to talk about sustainability and ESG considerations in investing in a listed infrastructure strategy. My name is Alex Aruzo, and I hope to see you again soon. Thank you.